A very good afternoon to everyone. I am Jasmeet Kaur, member of INMOS Club, and it is my immense pleasure to welcome everyone to this highly anticipated and interactive session on proposed changes in insurance laws. This session is jointly presented by Club INMOS and BIMA School. BIMA School is an initiative in insurance and financial education field that provides organizations, insurance professionals, students, and other interested in learning insurance practice-oriented sessions. The core team, led by Mr. Rajneesh Preti and Mr. Amit Pareja, consists of highly qualified and experienced professionals in the field of insurance and risk management, and are committed to bring value to every professional's life. And it is our honor to begin this session with a visionary leader and a source of inspiration for aspiring insurance professionals, Mr. Shrirang. Sir has proven leadership skills across various geographies and businesses. He has extensive experience in building businesses partnership in Australia, UK, and India. Sir has set up a joint venture uh, insurance company in India between a US insurance major and an Indian finance conglomerate, and has a founding director, and CEO of the joint venture. Mr. Srirang's academic qualification include a degree in law, a diploma in system management, and an MBA from JBIMS. He is a fellow of Indian Insurance Institute, a charter insurer, fellow of Charter Insurance Institute UK, and a property and casualty underwriter USA. His articles on financial issues, especially insurance, has been published in online magazines. He writes book reviews on contemporary issues as a hobby. Sir is also a certified executive coach and certified life coach, approved by International Coach Federation, and provide coaching as a social welfare. Now, I would like to invite our INMOS Club mentor, Professor Manoj Kumar Pandey, sir, and Mr. Amit Pareja to take the session further. Thank you.
Thank you, Jasmeet, for this good introduction.
Thank
And
you.
apologies to Pasrija ji, the name was spelled wrongly.
That's
okay.
fine. Yeah,
So thank you
I
very much,
thank you, sir.
Samant sir, for accepting this invitation. Because as Rajnish told you just before this particular session that your article, which was published on December 6th, if I'm not wrong, in Money Live, that has created a lot of buzz. And when I'm saying buzz, because we manage many industry-related WhatsApp group. So that article was shared there, and there were many inputs coming. And then only we decided why not to invite sir and have this interactive session, because that particular moment, whatever is happening right now, and your title was very important, disruptive changes in insurance industry. If at all I see as an insurance learner and not as a professor, I'm still learning that path that much. Perhaps the way we are calling the industry 1.0, 2.0, perhaps this will be in real sense industry 2.0. Because if you go by the history, of course, there was a time in 1956 was a milestone, 1972 was the second milestone. Then we came in 2000. For last 3 years, IRDAI has been giving lot many regulation and changes and basic changes. But whatever is under consideration at this juncture of time, if implemented in totality, would definitely change the very basic structure of the insurance industry which we have as of now. And in that context, sir, your article which was there was very thought-provoking, and that is why we invited you, sir. So I will like you to, subject to your convenience, sir, we request you to kindly first share your thought on all these points, and then we will have some follow-up questions from audience also.
Thank you very much. Well, first of all, thanks a lot, Jasmeet, for the introduction. Frankly, I could not believe it myself. But anyway, thanks for reminding me what sort of mischiefs I've been up to in my life. On a more sober note, the one kind of underlying motivation that I have in staying, I would say, peripherally engaged with the insurance sector is, it's been in a way a lifetime's work. And sometimes, looking at the past can help you, do a little bit of crystal grazing about the future. So that's where we are coming from. Now, in terms of the specific articles, I frankly, believe that
बालाजी वाले का ना दीपक सर ने
To
5 लाख
request
अप्रूवल ले लिए
audience,
थे,
please
5:35
mute
का
yourself,
बोल रहा था
please.
ना वो कल कि हमें तो
I think
Yes,
somebody
thank you.
needs to be on mute. Yeah.
Yeah, thank you. So this is more, I think that we've reached with the introduction of the new Insurance Amendment Act. Yeah. May I please ask everybody to put their phones on mute? Yes, it becomes a bit distracting. Even I am guilty of it sometimes, so it helps to be reminded of that. So coming back, but let me very quickly go back. Most of you know this. Some of us have had the privilege of having seen insurance business both in the nationalized sector and been there present at the time of opening up of the business, and then how the business has grown. Quite coincidentally, I think this year marks the quarter century or 25th anniversary of the licensing of the first private sector insurance company, which I believe was Royal and Sun Alliance at that point of time. And in relation, in collaboration with IRDA and other government officials, I think insurance industry has made a lot of progress from what it was soon after nationalization to what it is today. Is obviously a long journey. For example, and I'll focus more on non-life sector because that's been primarily my area of work. The growth of insurance in terms of the size of the market has been enormous. As of last balance sheet of IRDA, the premium income, anybody must have had figures. Our premium in, let us say, in one sector alone, 81 motor has been 81,000 crore rupees, which is unbelievable. So now what happens is that with the financialization of economy,
So it's a very humble request to everyone. So please keep your microphones on mute as we are having a session. Thank you.
so it is, thank you very much. So it's basically what happens is that there are 2 or 3 factors. One has been the financialization of the economy. Professor Pandey will perhaps bear witness to that. About 25 years ago, nobody had heard of the word financialization of the economy. It was simply economy as such. So one thing has been financialization of the economy and, insurance being seen as playing a big part in it. Now, that is purely a theoretical part of it. In real life, insurance affects all of us, both life and non-life insurance. And I think it's more important to look at what's happening in this sector in terms of how it impacts the ordinary people, you and me, ordinary insurance buyers, and that large section of the society, which needs insurance but cannot buy insurance as such. Now, in this context, having said this context, I would like to sort of jump over, and I'll be doing that back and forth, is to the very hot topic of insurance for all. And one of the reasons sometimes given for this extensive amendment of the Insurance Act, it's a pretty significant amendment, mind you, is insurance for all. So I will wrap up the insurance for all part of it, which I have covered in my article as well. And please feel free to interrupt me anytime. Is that, it sounds very attractive, that insurance for all, but all of us know that first thing is that we should have the asset to protect if we want to buy insurance. And the second part of even if we have that sort of asset, we should have the money to buy insurance. Now, the one asset or one social security need which we all of us have is life insurance. And life insurance has been in the country for at least for 100 years and more. And most of us are familiar with life insurance. The non-life insurance, essentially, you will believe me, at the starting point of the non-life insurance industry was purely a fire insurance against fire. And then when the industrialization in India started, it was basically protection of physical assets. Motor insurance in India, right until the beginning of the 21st century, was a small part of the business, so not a big part, because there are hardly any motor vehicles. I think some of the younger lot in the audience may not know that as recently as 25, 30 years ago, the annual production of private motor vehicles in this country did not exceed 50,000 units, whereas today it exceeds 4 million units. So one part of it is that the insurance has grown by leaps and bounds in the non-life sector because of the compulsory requirement in the motor insurance. So bringing it back, how does that relate to insurance for all? Now, frankly, the only thing that will grow in terms of relevance to everybody is motor insurance, whether it's for four-wheelers or for two-wheelers. And the people who know the statistics still believe that about 40 to 60% two-wheelers, which let us say is an ordinary person, ordinary citizen of this country aspires to have, are uninsured. This is one of the reasons why the regulators introduced a 3-year policy for motor vehicles a couple of decades, I think about a decade ago. So that answers one part of the question, insurance for all. The second part is health insurance. And in health insurance, obviously, none of us want to go, if we fall ill, want to go to a government hospital because of this level of services provided. And the fact remains, and I think it's more important for the forthcoming generations to remember, those today who are students and aspirants of entering the insurance industry, is that there was a period not far back ago, where government hospitals were supposed to be the best places to go to if one had a complicated illness. And how the situation has changed, because the image of government hospitals is so bad that people are buying private insurance. Now the question arises that how many people can afford it? All of us know what happens is that health insurance today, as it is seen, is essentially a hospitalization insurance, not health insurance per se. Now, if, for example, you suffer from a bout of flu, have to be at home, you don't get admitted into the hospital, you don't get any insurance money for whatever sort of money you spend on getting treated. And this is where probably insurance for all is needed, and it's not existent. So I think this kind of, let us say, should act as a reality touch for everybody insurance, who wants to talk about insurance for all. Now, in that context, the article was triggered by that. Then I kind of looked at what are the new changes, whether the 100% FDI is relevant, and more importantly, if we set aside 100% FDI, will a composite insurance license really, really help in terms of, kind of an insurance for all, quote unquote, that kind of approach. This is more or less my opening remarks. I would not go on and on about it because I suppose you have a lot of questions, and some of the dimensions of, my thought process will come across when we deal with the, individual bunch of questions. Dr. Pandey, would that, and Amit, do you think that's a good format if I stop here and take the questions one by one?
Yes, sir. Just I have put in the chat box also. We do have certain structured question to you, myself and
Yes.
Amit. And
Yes.
after that, we will open the floor for the audience also, if at all they have got any follow-up questions. So, sir, beautifully you have summarized the insurance for all part, because this is challenging. You have clearly mentioned that whatever growth we have seen in the insurance sector, it was primarily driven by motor and as well as health. Health, particularly after the COVID part. So, how sustainability is the important aspect. But we are hopeful that as a nation we will progress, and as the economy progress, the insurance sector will automatically progress, sir. Amit, you can start with that FDI question if at all we have that certain question in our mind.
Yes, sir. Thank you, Professor Pandey. Thank you for this opportunity. Sir, I think one of the points which you talked about in your article related to foreign ownership and market attractiveness for Indian from Indian perspective. So one of the things which regulator has proposed in the act that the removal of 74% cap which is currently there in foreign partnership, they want to make it to 100%. So, what do you think? Uh, uh, how it is going to be? I think responded by the market, because currently even 74% is not have been picked up by foreign partners like the way it was expected. They have not shown great interest in increasing their stakes to 74%. So, any thoughts on reaction from market when this happens?
That's very interesting question. And this is, I think, I mean, you hit the nail on the head by asking that question. See, what happens here is, look at the numbers. And quite coincidentally, after I wrote that article, one of the business papers, I think it was Business Standard, came out with the factual information on how many companies have taken advantage of FDI being raised from 49% to 74%. And there are only two companies in that too in life sector which have raised their foreign equity from 49 to 74%, that is to the full extent. And I would not go into the reason for why these companies have done that. But let's just, I think it is safe to say that there have been a couple of other structural reason or JV partnership issues because of because of which they have gone up to 74%. And not entirely due to attractiveness of the market. Okay, that's part one. The third insurance company, again, life company, in which the JV partner, the foreign JV partner, has raised its shareholding beyond 49%, but not up to 74%, is a company, I'm sure all of you who read financial newspaper know that their Indian partner is in the bankruptcy court. So he cannot, meet the additional capital requirements. So they had only one choice, either to wind up the company or put in more money, which the foreign partner did as and when required. So this tells us something about the attractiveness of the insurance sectors for foreigners. As far as non-life is concerned, to the best of my knowledge, no single insurance company has raised no single foreign partners, to be precise, has raised its shareholding to 74%. And let alone, so I think that answers the question is how many of them will go up to 100% once that 100% limit comes in. Obviously, there might be other factors beyond the attractiveness of the market, which might prompt people to go up to 100%. And one of those factors could be that, the also runs in the market. You see, currently the structure of the market in life and non-life both is there are some very successful private sector companies. I'm not here talking about the non-life insurer, the public sector companies. There are 3 or 4 market leaders in the private sector in both life and non-life. Others realize that no, they are not able to make any mark in the market. So they would probably sell out to the foreign insurer and get out of the business and basically focus on their core business. So does that answer your question? Hello?
Yes, sir. Yes, sir. Fine.
Yes.
Sir,
Yes. Thank you.
one thing where we found you to be little bit critical was about this process or the proposal of giving a composite license, because you have given apprehension about the corporate governance issue. But sir, having a composite license is an universal practice. I myself have the exposure of Middle East market, and there are almost every company is composite. So why do you feel that, sir, that in Indian condition this can be a tricky situation?
That's a great question. And yes, the answer can be very, very subjective. And that is why I alluded to the fact that it is more an issue of corporate governance than than purely a regulatory concern. See, there is a provision for composite license in a number of jurisdictions. I'll like to make a distinction in terms of which jurisdictions these are. See, mostly Middle East, yes, there is a composite license. It relates to the size of the market, and it also relates to the sophistication of the insurance distribution network. Now, in Middle East, mostly you probably worked in the Middle East. How big is the size of the market? What is the consumer awareness about their insurance rights? You know, in the Middle East, if a claim is not paid, the CEO of the insurance company is straight away put behind the bar. I'm not trivializing that whole issue, but the enforcement part in the Middle East countries is something which I think all of us are familiar. One of the companies I was working for a long time ago, its Middle East manager was literally arrested because they didn't pay a motor claim in time. So he had to scramble around. So as I said, it depends on the regulatory enforcement of these things. Now, in terms of the more sophisticated market, and I have worked in 3 very highly sophisticated markets, yes, the insurance regulations do provide for a composite license, but they've built a huge amount of firewalls around it. And these firewalls include...
Mr. Shiroha, please mute yourself.
Okay, I thought there was a question coming. So do we have those kind of firewalls? That's the regulatory part of it. And I looked at the amendments here, and one of the amendments says that, one of the proposed amendments says that it's simply an extension of existing regulation about life insurance, that, you know, payment of bonus and dividends shall not be declared out of the policyholders' funds, or they can only be declared out of the surpluses of the insurance company. This is section 49 of the current Insurance Act. Now, what happens is that, you know, it's very simple to enforce when you have, you know, a completely independent vertical in terms of life, another in terms of non-life. And there, the obfuscation of, you know, or transfer of funds between one and another is a bit difficult. Now, this is where corporate governance comes in. And my biggest example of bad corporate governance is the recent scandal about the payment of commissions to brokers. I think all of those who are in the field know that right up to last year, all these rules, regulation about commission payments were thrown to the winds. You know, there was a figure about, in one given particular year, 29,000 crores worth of commissions were, you know, paid in different forms, on which, and this came to light because of the GST part of it. Now, if most respected insurance companies, and I can't name one, or I wouldn't like to name one, can do this kind of chicanery, despite the you know, 40C limitations and all kinds of corporate governance, the board supervision and all, just imagine how easy it will be for them to mix up funds, regardless of the accounting regulations in force. And that is one of the primary reasons why in developed market, whereas this kind of licenses are present, the kind of checks and balances which are there make the compliance costs very, very heavy for any existing composite company. And that's why this is not seen in majority of big markets. Let me give you an example of UK, where I worked firsthand. is that there is only one company, which is Aviva, which is also in India, where they have a composite, they use their composite license. And it's because they have a legacy. They were essentially a life company, which kind of, moved into non-life. So their life company, at one point of time, life business was bigger than their non-life business. So it's very I would not like to go into the nuts and bolts of how the finance and accounts and other policies can be mixed up. But the board governance or the governance, corporate governance standards, which led to the GST and commission scandal in our country, not very far, do not inspire confidence about the ability, the willingness, ability of the management not to kind of, let us say, doctor their figures, and the ability and competence of the board to monitor such transgressions. So I think that, and combined, just imagine, combined with these, lowering of the limit on minimum capital requirement, and there are other provisions which can take care of this, I would not go into that, is essentially an open season for anybody. Sadly, anybody who can manage the regulatory, let us say, the regulatory structure. And there are umpteen instances where, a suspicion arises. I have to be very careful about saying this. A suspicion arises where the regulator has been blindsided. Whether willingly or unwillingly is a different question altogether. Let's not go into that. So looking at what actually happens inside the industry, it's not purely a matter of technicality. It is a matter of mentality of the management of the people in insurance sector, which makes me worried as a professional who has seen the inside out of the risk being carried by a composite license.
I completely agree, sir. I mean, even if when the IRDAI got the expense of management regulation, some of the company have defaulted on that also. And secondly, just day before yesterday, there was a news item in circulation that the insurance companies are seeking the help of IRDAI to curb the commission rate paid to the MISP, that OEM dealers. So this is really a very funny situation. Amit, please go ahead with the next question, please.
I think before we go into the next question, I think we have, I think Sandeep has asked, which we should raise to sir, how the proposed recent changes by IRDA in Insurance Act and many other regulations will help in achieving the vision of insurance for all by 2047. And what are the key factors which will influence to achieve this vision, sir? Any thoughts?
Yeah, I answered that question already.
I think Sandeep must have joined late.
But I'll very simply summarize that. The answer is that, if wishes were horses, beggars would ride. I hope all of us have heard that saying. Insurance, basically, why it should be affordable. Yes, I would like to buy a life insurance, but do I have the money? And in this context, let's talk about an ordinary person. And I would not go on and on about this. An ordinary person is, in fact, I'm afraid it's not even you and me, because I and you, we buy insurances because we don't trust, we buy insurances in three different things. First is because we own a two-wheeler or a four-wheeler. B, because we don't want to go to a government hospital when we fall sick. And C, in terms of life insurance, we have some, we used to get that deduction under Section 80C, which helps us. And obviously, we worry about our family's futures if something happens to us. But there is a huge mass out there. And I would say it's probably 80% of the people who need insurance, who deserve insurance, but who can't afford to buy insurance. Here, I would just relate to you one statistics. And that one statistics is that it was published in a very credible journal. There are about 60 million people in India, which means 6 crore, who have, in absolute numbers, an income equivalent to $10,000 per year. Now, you can imagine that $10,000 per year goes a very, very long way in India. And these are the people who are the essentially buyers of insurance. The remaining out of 140 crores, even 130 crore people are people who need insurance, can't buy it. So just by changing, the minimum capital requirement, having the composite license, or in bringing 100% FDI, how does that ensure insurance for all? Maybe my intellectual limitations show up here because I simply can't visualize the scenario. Unless the purchasing power of people in the country reach a certain level, insurance for all is a very, very aspirational target.
Well said, sir. Thank you. I think one of the things which also we wanted to understand from you is the talk or point which you mentioned about government-sponsored health insurance schemes. So, could you please delve into the challenges posed by these schemes, particularly in claim servicing and its sustainability?
Well, the challenge posed by this insurance scheme is, again, I'm afraid I'm wading into troubled waters here. But I suppose I have explained these views somewhere in writing, and I haven't been arrested so far. So I will mention it again. See, what happens is that the state, and I don't mean by that state government or central government, the state has relinquished its primary purpose of, apart from providing, and this here we are going into slightly wider areas of security, law and order, and all. In our country, one of the primary service issues with the state was also healthcare, and the state has not been able to manage it. So they found an easy way out, is saying that okay, we will give XYZ section of people up to a certain amount of insurance, and we'll pay the premium for it. Then they invite tenders. Some of the companies offer tenders, and then a certain number of people, 10, 15 lakh, or probably 1.5 crore in a given state, feel that they have been covered by this insurance scheme. Now there are two fundamental facts here, even before we go to claim servicing. These health insurance policies, again, as I said before, cover only hospitalization expenses. What are your and mine primary worries about, or a poor person's, is the day-to-day medical expenses. How many people have major hospitalization emergencies in life? Very few. The second part of it is how the claims are administered. And I keep getting referrals from a lot of people about speaking to my erstwhile friends in the insurance industry, most of whom have retired now, so I stopped getting those requests. Is a perfectly genuine claims are not being paid on one pretext or the other. So I only hope it doesn't lead to a scenario in the future where somebody wants to emulate what happened in New York recently. I'm sure you've known about that. And that's a big worry. So health insurance, state insurance scheme are good. I'm sure they are very well intentioned, but they actually brush under the carpet two things. One is the relinquishment by state of its primary function of providing primary health care to deserving people. And secondly, the inability of the people to pay for their day-to-day medical expenses. This is what has prompted, what I had written about it.
Sir, another attractive proposition or the proposal is to reduce the entry barrier, bringing down the minimum capital requirement of 100 crore to 50 crore. Of course, their intent is to maybe starting a small insurance company, or maybe insurance company limited only to a particular line of business. But if at all we go by the basic calculation time value of money, what was proposed maybe 100 crore 25-year back is practically 25 crore only in today's context, sir. Further bringing it down to the 50 crore, I mean, majority of the people are believing that this is too low barrier, particularly for an insurance company. And some of the very stalwart, including Mr. N. Rangachari and other senior people in another article, they have criticized it severely. I mean, they are not happy with this lowering of the entry barrier, sir. So what is your take on, sir? Of course, you have not criticized that aspect very much in your article. Maybe you passed it simply. So what is your view on that, sir?
I'll comment on the last one first. There is a limit to how much one can criticize. Otherwise, one gets one, rather than a critic, one becomes, a naysayer, or one doubts everything. Nothing is, this man has nothing positive to say. So that's why I resisted the temptation. See, what happens is that when the first lowering of capital requirements, so I completely agree with you when you say that 100 crores in 2000 is 25 crores today, is for health insurance company particularly, it was relevant. And I mentioned that. See how big a single health insurance claim can come if it is a purely insurance company, health insurance company. You can imagine how big a claim can come. 5 days of hospitalization for a heart, let us say, heart operation, maybe in today's case, 5 lakh rupees, 10 lakh, 20, 25 lakh rupees. Okay, the company is not going to go bankrupt unless they get 500 such claims. So reducing that capital requirement was useful, relevant at what point of time. If you leave aside the issue whether people should kind of forget the government's duties to provide good health care and go for health insurance, that's more an ideological issue than anything else. So 50 crores was relevant. Now today, if we really want to spread insurance at a lower cost, lower capitalization cost, so let me turn this question around, saying that if you want to make we want to bring down the entry barrier for people who want to kind of provide cheap insurance coverage, limited insurance coverage to people who have very limited buying power, or you have to look at nothing else except the SEVA report, SAMI report. Have you heard of the SAMI report? Anybody in the audience? Maybe not. This was standalone micro insurance. There was a committee formed in 2020 by IRDA to recommend micro insurance companies. And the SAMI report was submitted in 2020. One of the things which they kind of recommended was, bringing down, subject to certain safeguards and limitations, the minimum capital requirement to 20 crores to register, not set up, to register as an insurance company for, a limited purpose. Now, what could that limited purpose be? So it came out, and this is very interesting. I'm slightly going off track, but since here I can say that the audience is really interested in the fundamental questions facing the insurance, let us say, landscape here. Sorry? Okay. I thought somebody asked a question. See, what happens was that there was a self-help group in Mumbai, which was there in others also. They had, brought out a unique concept of reimbursing outpatient medical expenses to a certain group of people, mainly living in the big Dharavi slum of Mumbai. And I'm sure everybody has heard of that Dharavi slum. The huge people, maybe 20, 30 lakh people, they could not even afford to pay the 20 or 30 rupees fee of our family physician plus medical. So they pooled together everybody's resources and started that scheme. And then they inquired with some more knowledgeable professionals how that can be converted into an insurance company, which can also provide cheap outpatient, mind you, outpatient insurance coverage on a reimbursement basis. Now, this is what led to the setting up of SAMI in some way, but there must have been other factors also. And the SAMI recommendation, I do not know what has happened. If anybody in the audience has any recent update on that, that is actually very welcome, because I don't know that. But I would think that instead of reducing capital requirements to 50 crores, and this is just one part of the answer, I'll come back to the next part of answer very quickly, is that why not make a special provision for self-help groups? Because the point is that if you're going to set up a standards general insurance or life insurance company, and since I know a little more about general insurance than life insurance, do you know that for a standard general insurance company, and I'm sure you do know, Rajneesh is here, he's in that field, is that just the software for running a non-life insurance company basically costs about $100 million today. Rajesh, am I right on that? Just the software part of it.
Absolutely, sir.
So I don't know where it's going to go. So if the purpose is to allow people to set up micro insurance companies, then we need to look at it differently. Okay, that's one part of it. I'll just come to the second part of it. Now, about a year ago, there was this huge statement by one of our very respected ministers that our infrastructure projects are not going forward because there are no performance bonds available in India. So he rather directed the regulator to find out the possibility of insurance companies issuing performance bonds, which is essentially a guarantee and indemnity business. That is, you take up a contract for, let us say, a small thing is building up a building, or a contract for building a 100-mile road. See that there is a performance guarantee that within a specified time, within a specified cost, with a specified standard, if you haven't been able to do that, the bond will be invoked. And this is what the Honorable Minister, with his best intention, wanted to do. And I have had the opportunity of interacting someone in this connection because I used to represent Travelers India in India. Travelers is a big on performance bonds and indemnity and guarantees in the Western world, wherever they operate, including some one at least second world country. So the point is that if you want to do that, then again, capital requirement can be very limited, but there are other things which need to be addressed. And those things, that ecosystem doesn't exist in India. So, before finding such simplistic solutions, and I would call it simplistic, that reduce the capital requirement and then see how many companies come, make specific capital requirements for specific sectors. Now, that is going to be very difficult to administer. It gives a lot of regulatory discretion. And in our country, giving discretion to anybody is essentially, it's a downhill path. So those things have to be taken into account before you kind of bring along and across the board, requirement of lesser capital. Now, just the final part of my question rounding off here. Obviously, the proposed amendment also says that the regulator has the discretion to specify separate capital requirements for separate classes of business. But that discretion seems to have been introduced more with a view to, the enabling the composite insurance company. Like, for example, if a business group wants to set up a composite insurance company, provided the law gets amended, so regulators say that for life insurance, this is the capital requirement, for non-life, this is, and for health insurance, this is one. They are not going to specify different capital requirements for each specific class of business because it's very difficult to administer. You might have the best intentions. So you have to also see the reality of the execution, particularly in our environment. So I hope that answers your questions about reduction in capital requirements and where it's going to lead us.
Yeah, Amit ji, next question.
Yes, sir. So one of the things which you highlighted in your article is about misclassification of motor, personal accident, and also travel, I suppose. So any thoughts on changes, sir, which you would like to recommend to improve clarity and accuracy in pricing, especially in these areas?
Very important question. Right? The two aspects, one is classification, another is accuracy in pricing, and they are interrelated. Now, I've been interacting when I was actually inside the industry with the regulators, and I've had the good fortune, and this is just to set the context where I'm coming from so that our audience doesn't assume that I'm talking from a very theoretical platform. I interacted extensively with the first regulator when all the regulations being made. And one example I can give you is that when the commission regulations were being set up, I had the opportunity, and obviously the regulators were very, very carefully kind of interested in what I was saying, was that, sir, please do not mandate a cap on the commission, because with the scramble for market share, it will become a floor, not a cap. And this is exactly what happened. somebody asked me about the auto dealers doing, selling insurance. The first thing when I set up my company and went to an auto dealer, he said, "Sir, everybody is paying 15%. आप क्या दोगे उससे ज़्यादा? कैसे देंगे वो हम आपको बता देंगे." I hope there's nobody in the audience who doesn't understand Hindi. If not, I'm happy to paraphrase that in English. So everybody is paying 15%. What else you're going to give me? So that was one of the things which was an interaction with the regulator. The second part of interaction with the regulator is that I said that, sir, when the 1938 Insurance Act brought out the format of insurance revenue accounting, the accounting was in nascent stage. 1938 to in those days, I think it was 1999 or 2000. I said the account has changed. You have a huge amount of computer-based data. The kind of data analytics which have come today, they were not even imagined at that point of time. Despite that, there was still a lot of computing power available to crunch the numbers. And I said one of the primary areas is that please introduce separate reporting requirements for each type of business, not class of business, mind you. And within that, the most obvious starting point is motor business. How come? Now, I'll come to the specific. All of those, and I'm sure all of you have seen the balance sheets of insurance companies. What are the three classifications? Fire, marine, and miscellaneous. What is under the miscellaneous? Everything which doesn't go under fire and marine. And what is the biggest component of miscellaneous? Motor. Now, even within motor, there are two distinct, insurance processes. One is the physical damage. The other one is third party. Now, I have some statistics here. As per the last report of the IRDA, total motor premium was roughly 81,000 crores for all the companies together. Out of that, 31,000 crores was own damage. Okay, 51,000 was third party premium. Now, third party by itself is a statutory requirement, and it is a completely different ball game than physical own damage. So no matter who says what, the fact remains that we don't know what is the loss ratio in the third party business salon. Obviously, people report this 112% and 15% and all that. So what is happening today? Just look at your own motor policy. So motor policy will have one own damage premium, which will be as low as you can push the broker for, and there will be a standard amount of third party premium. Now that third party premium is how legitimate or how accurate it is, I don't know. But one telling point is that one of the insurance company, and obviously it will be pretty dangerous to name that company, has been making money purely out of third party premium because their primary strategy was to insure all the large truck operators. Okay. And if a third party, there huge amount of third party premium is there on a truck or a commercial vehicle, and simply wait for MSCTs and the legal process to sort itself out. So within that time, for an average large third party claim, the time is 7 years. Now in 7 years, you are sitting on a huge amount of making money out of that. And by the time the chickens have come home to roost, the CEO has already taken his share options, cashed them and got out. Now, this is a slightly cynical bit, but it is a fact. So the point is that we need to have completely separate revenue accounting requirements specifically for miscellaneous class. Because as you know, in miscellaneous, apart from motor, there is everything which is not fire and marine, it is there. And those reporting requirements should be based on the premium component of a major class. For example, if you are an aviation insurer, which nobody is, because GIC is the primary aviation insurance, is that how much money has come out of pure airlines premium? How much, if your indemnity and performance guarantee, how much money has come out of that? If you are purely writing public liability or directors and officers, how much money come out of that? None of that is available. Tell me, any one of you, the audience here, if you are really interested in insurance balance sheet, tell me if you have seen in any balance sheet, and I would be happy to be corrected, where the miscellaneous portfolio has been sliced and diced. So does that answer your question?
Yes, sir. So Sir, one of the item which you have supported very well in your article is all about removing this restriction of the agency channel. So do you see this is one step towards the goal of getting our MGA system in India?
Yes, actually, what happens was that, I'm looking at it from a completely different point of view. And the different point of view is, again, that thing, insurance for all, insurance for, let's say, ordinary person who has a capacity to pay, but very small asset base. The thing is that, in the rest of the world, and I'm sure many of you have seen how the insurance market works in Middle East everywhere, is that insurance agency is a big employment area for a lot of people. Okay, so number one is that in the Western world on the high street, you will have a lot of shops offering you insurance. That is a big employment area for people. Now these are basically independent agents. They represent a number of companies officially, both life, non-life. Currently, we have just 3 sectors: life, non-life, and health. And then they can offer you competitive products and competitive premium rates on that. Why not do that here? Now, what has happened is that because of this restriction on one life and one non-life, and now one health insurance, if I am the insurance agent, I'm forced to set up a company, an agency in my own name, where I can offer just 3 companies product, then another in my wife's name, the third one in my driver's name, fourth one jokingly in my dog's name. So this is illegal. This is, this is unhealthy practice. So at least by allowing people to represent more than one insurance company, the buyer can legitimately say they provide me officially the premium quotations for different companies for my risk, which they do even now, but do it, in a somewhat gray zone. And secondly, it will attract more and more people who do not want to indulge in this kind of shenanigans to take up insurance agency and spread it to small and C class and D class cities, where one person, where the market is not big enough for a tied agent to be there. So one person can be there representing multiple insurance companies, and that's the biggest advantage of removing this restriction.
Amitji, next question
Yes.
you have?
Thank you. Yeah, one concluding question I have, Professor Pandey. I think one of the important things which we would like to know you, sir, is though a lot of proposals are there in for changes in the act. So any advices while for implementation or any other thoughts you may have to all these stakeholders, regulators, insurers, agents, and customers as well, in navigating these changes? Because a lot of proposals come, they do get implemented, but the final thing is that we should be able to navigate well. So any thoughts on that?
Well, I'm sure, in all seriousness, there are a lot of people in the audience and outside who are giving serious amount of thought to this particular issue, and they won't be much different from mine. But the fact remains that, it's not the fault of the regulator or the lawmaker. You see, insurance for most of the people is such an esoteric subject. Either it's esoteric or it's peripheral, that when IRDA publishes a consultation paper, nobody bothers to either respond to that, or nobody does a follow-up. For example, this SAMI paper which I was talking about, which I was alluding to, published in 2020, a lot of it made a lot of sense. But I don't know what has happened to it. Nobody has asked a question to either the regulator or the government. Okay, yes or no, at least tell us what's happening on that. So going forward, I think people like you, and I'm using word you as collectively, generically, than as an individual, should stay more and more engaged with the regulatory apparatus. And they do welcome suggestions. They do welcome public involvement. I've seen that. So as insurance professionals, if you keep an eye on what's going on in the market and on the regulatory field and stay engaged, I think that's going to be a lot of help to the future insurance buyers. Now, I haven't answered your question directly, but I've given you a context on that because
Got it.
it will be presumptuous for me to, provide a prescription to the ills which are prevailing currently.
Yeah,
Sir,
you are right.
now I
It
will
makes
be
sense.
asking the last question rather, sir, because my students are attending your session as a class. You can see that they are sitting in the class itself. What kind of advice or guidance you'd like to give it to them? Because they will be joining insurance, this particular class will be joining industry in 2026, sir.
Oh, that is, I think that's a life advice. That's not a professional advice.
Yes, sir, please, please.
I think it's very interesting, you know, that so many people are, interested in insurance as a career. Please give very, very careful thought to, the future trajectory of the business. I believe that the way it's grown in the last 25 years, if you just extrapolate that trajectory, that's going to be fundamentally a big faulty assumption. That may not happen. I'm the last person to say that will not happen, but that may not happen. Number one. Number two is the emerging AI challenge. And I know I sound a bit ominous here, but AI is going to, and perhaps there are more qualified people in this room than me who can definitely project the trajectory of AI, will make a lot of conventional human roles, the roles of conventional human beings in the insurance field, rather redundant. That may happen next 2 years, that may happen in next 5 years. So please equip yourself with an alternate skill before you take a plunge head on into insurance business. To put it colloquially, please don't get carried away by the glamour of insurance, which is currently seen as financial services. So that will be my advice. I would prefer to sound a note of caution rather than carry away the audience with the hubris that's prevailing everywhere else in the financial services. That's going to be my short answer to that.
I
Thank
think
you,
I
sir.
made it
I mean,
sense.
do you have any question or Jaspreet can propose vote of thanks? I mean, if at all any question is there.
No, it is I who should be proposing a vote of thanks.
I think the last point which you said, sir, makes a lot of sense, especially with the kind of way AI is going to rule all of us in different, not only in insurance, everywhere. So that made a great sense. While Jaspreet will say a common vote of thanks, I would like to also invite Rajneesh here to say gratitude to you because he's the one who discussed with you, coordinated. So just quick word from Rajneesh, and then we may hand over to Jaspreet for closure.
Thank you very much. There's no law of diminishing returns as far as thanks are concerned. Please go on.
Yes.
Yeah, so Shrirang sir, I think first of all, thank you for writing such an impressive article and then doing this session at such a short notice. I think it's inspiring that the way you are contributing to the insurance community even after retiring. So thanks a lot for sir doing this. Uh, Thanks a lot to Professor Pandey as well for proposing this session. I think Professor Pandey has been a trusted friend of mine for like several years now. He's my go-to person for a lot of things that we do. And I think BIMTech students are really very fortunate to have a guide like him who bridges the gap between academia and the real industry in such an impressive way. So thanks INMOS Club, thanks to my colleague Amit at BIMA School for coordinating all this. And I think we should have more sessions like this. And I look forward to those sessions. Thank you.
Thank you very much. Thank you, Professor Pandey. Thank you. My thanks to the audience as well.
Our girl is coming. Host is coming to.
Yeah, over to you, Jasmeet.
Formal vote of thanks. Yeah,
So
Jasmeet,
as
over
we
to
come
you.
to an end of the session, I would like to extend my heartfelt gratitude to everyone who made this session a success. I would like to express my sincere gratitude to our esteemed speaker, Mr. Shrirang Samant, for sharing his valuable insight. Sir, your perspective have truly broadened our understanding and inspired us to think more critically. I would also like to thank Mr. Rajneesh Upreti, and Mr. Amit Pasreja from BIMA School for organizing this session with Club INMOS, and also our mentor, Professor Manoj Kumar Pandey sir, for his guidance, encouragement. And lastly, a big thanks to all the participants for your active engagement, thoughtful questions, and presence throughout the session. Thank you, everyone.